Earlier this month, a federal judge blocked a rule put forth by the Consumer Financial Protection Bureau in early January before President Trump took office that would have made it easier for many Americans to secure loans by removing medical debt from credit reports. Well, joining me now is Kevin King, Vice President of Credit Risk at LexisNexis Risk Solutions. LexisNexis is a subsidiary of NYSE listed Relics. And Steve, Kevin, it's great to have you on the show here. Apologize getting my all of my notes organized. What does this mean?
Oh, morning, Chris. And I think it means a few notable things. The impact may not be as severe as it looks on paper. The CFPB had estimated that if medical debt, and we're talking large dollar medical debt, so debt over $500, if that debt were to be removed from credit reports, it might give about a 20-point jump in scores like, say, FICO, over where those consumer scores sit today. That jump will now not materialize as that debt is going to stay on credit reports. Critics are going to be concerned that this presents a new obstacle to those 15 million consumers accessing affordable credit, housing, employment. Certainly any obstacles to those goals doesn't seem beneficial on paper, though I'd argue the impact won't be as severe as some.
And how does LexisNexis navigate this? What does this mean for your company?
Yeah, so my area of the company focuses on alternative credit debt. So we're the leading provider of this in the United States. We provide hundreds of millions of consumer credit assessments. Think not too different from a FICO or a Vantage score today to lenders who are often using that data together with a FICO or a Vantage score or a credit report to get the most complete view of consumers' ability to repay a loan. Right? So our view is when we see gaps emerge or we see lenders maybe approach with some skepticism their understanding of a consumer's credit profile, we fill in the gaps to help them lend to more consumers at more mutually financially beneficial terms.
Interesting. And so what this might mean over the course of the next, what will be 3.5 years of this current administration, how are you navigating that?
I think from our corporate strategy, the goal is always going to be how do we pull in more insights that speak to consumers' true credit quality, their ability to repay, their willingness to repay debt. There is going to be a need to get that more complete picture, regardless of the regulatory environment. And as you know, this is something that in 4 years could come back around. I'm not sure if it's going to matter that much, in part because many lenders already choose not to look at medical debt when they are evaluating consumer credit quality. But if it does come around, we'll be prepared. Regardless, we think we have something important to offer.
I'm interested just to hear here in terms of the demand that you're seeing for your solutions and products and services, Kevin, in an environment like this.
Yeah, I think there's increasing demand. Some of it is coming from the economic conditions. A lot of it comes from what we're seeing is the increased competition in the fintech space. Essentially, you could think of it like this. The more pressure competitively that lenders face to offer consumers optimal terms, so those consumers ultimately apply and choose to do business with those financial institutions or fintechs, the better. Right? The more consumer choice, the better. Right? And so when you're in those competitive environments, you need to figure out how you improve your loan terms without introducing big losses. Right? How can you safely be more aggressive in your lending stances? The best way to do that is to simply better understand the profile of the individuals who are knocking on your doors, seeking out those loans. And that has led to really strong growth in our business over the last, say, 5 to 7 years.
Are there any other insights or recommendations in general when it comes to risk solutions, Kevin, that you can offer our viewers?
Look, my perspective would be the more insights that we can offer to enable more companies to engage with more consumers, the better everybody's going to be. We're in a pretty good place. Right now, the regulatory environment is one that is very friendly to data privacy, but we're always going to behave as though we're under the strictest of standards. We deeply value consumer privacy, but we think we're putting the consumer's interest forward here. again, in times where maybe there is some disadvantageous data that's going to stay on consumer reports, can we bring positive signals on consumers' ability and willingness to pay to bear to ensure that
Yeah.
doors stay open for them on affordable credit,
What do you
housing, and employment?
what do you think are the challenges that can be addressed when it comes to the consumer landscape in general right now?
Gosh, when I think about major risks that consumers are facing, this medical debt issue is real, right? But it is really simply about credit reporting. People like me care about that a lot, but I would really distinguish it from student loan resumption. To me, that is the major challenge we're monitoring, Kristen. Talking about 40 million loans. We know those loans are issued to a consumer demographic that is, maybe by definition, highly educated. They're out in the workforce. Only 40% of those loan holders are making payments today. We've already seen 5 million default. We're expecting at least 10 million by end of year. And that's going to have a wave that impacts a lot of the businesses that your viewers follow. Financial institutions, consumer discretionary spending could be impacted because that is real debt, and the federal government will be doing wage garnishments, they're going to withhold tax refunds. So the ability for that issue to reverberate across the credit lending environment, but also beyond, I think exceeds medical debt. Okay, people like me, they're both pretty interesting.
Kevin King, Vice President of Credit Risk at LexisNexis Risk Solutions. Kevin, thank you so much.
Of course, and thanks so much. Take care.
You too.